Hi, today I'm going to use the book's PowerPoint to go over Chapter 10, Strategy and the Master Budget. The chapter's objectives are listed, and we are going to focus on the purpose and importance of a budget, the different types of budgets, the process of creating a budget, and how each budget fits into the master budget. First, let's define a budget. A budget is the company's plan of action for a specific period. It identifies the resources and commitments required to achieve the company's goals for that period. Some of the purposes of a budget are coordination between departments. Every department knows what the other one needs in order to complete the project. It is used as a guideline for operations and a projection for the results. It helps identify problems such as bottlenecks when one operation delays everything else. Management communicates the plan and goals for the company. It defines expectations. Employees know what they are supposed to do. This could help with motivation. Usually some employees even participate in the budgeting process. This makes them relate to the budget and more accountable. And lastly, it provides authority to acquire and use the resources. It kind of serves like the approval and the sealing of expenditures. Next, the book talks about strategy and budgeting, which must be interrelated and integrated. The budget should be built to achieve strategic plan. Strategic planning involves examination of both internal and external factors. Knowing those will help the company succeed. You will learn about this in the strategy class, but here are the major things to know. Internal factors are strengths, which are what the company is good at, and weaknesses, which what the company is not good at. And external factors are opportunities, what the company can take advantage of, and threats, what the company should be aware of. Now we can tie the strategic goals into long-term objectives. Strategy provides the framework for the plan to be developed. Long-term plans are usually between 5 to 10 years. Companies use a capital budget or a master budget to implement goals and objectives, and companies must plan for their expenses. The master budget is the plan for the period. It's just the big picture. We're putting goals and objectives into actions. Everybody knows what is expected of them. It's pretty much the how part. How are we going to achieve our goals? For example, your goal is to graduate with a high GPA, I hope. So your plan is to study and devote time for each class. The more details you have, the better the plan would be. The master budget is comprised of two main budgets. The first one is the operating budgets. What resources do we need? What activities are we going to need? And the second part is the financial budgets. What sources we can use to finance those activities. They both are related to each other, of course. The budgeting process differs from company to company, depending on the size and the type and the industry, but usually it includes the following. Budget committee that oversees all the budget matters, for instance, approving the budget goals, monitoring the operations, reviewing the results, approving the revisions, and usually includes the CEO, some vice presidents, and the CFO. The budget period, usually a fiscal year, and most companies have a 5 to 10 year budget. The next step on the process is the budget guidelines. The committee issues the guidelines looking at various factors, internal and external. And each unit budget department prepares its budget according to those guidelines. Next, the initial budget proposal. Each department prepares a budget according to the guidelines. Then we have negotiation, review, and approval. Proposed budgets go through a review. The committee gives the final approval, and then the CEO approves the entire budget. Revisions can be made to the budget when newly learned internal and external factors might cause the need for a revision. And obviously, if the budget doesn't work for the company, you must revise it. To prepare the individual budget, you have to take 3 steps. First, you got to define the bottom line information contained in the budget. For instance, the sales for the upcoming period. Then you have to determine what that information is a function of. Budgeted unit sales, budgeted selling price per unit, stuff like that. And lastly, you got to put together information in a user-friendly way. Every organization's number one goal is to sell the product or service. That's why this is the most important budget. Several factors are considered when preparing a sales budget: current sales level and sales trends of the past few years, general economic and industry conditions, competitors' actions and plans, pricing policies, credit policies, advertising and promotional activities, unfilled back orders. Using this information, a company can predict its sales volume and the selling price. We're going to use this company throughout the chapter. For Carey Industrial Company, this is the sales budget. We check for each month what's the sales in units and what's the selling price, and then we get the total sales. So for instance, here we have the April, May, June quarter of the year. After we finish with our sales budget, we can proceed on to other budgets. For instance, the production budget. To figure out the production budget, we also need to know what was the beginning inventory and what is the desired ending inventory. So as you can see in this formula, the budgeted production in units is the budgeted sales plus the desired ending inventory minus the beginning inventory. Let's see an example. Using the Carey example, the beginning inventory was 5,000 units, and that's assumed. The desired ending inventory is 30% of the following month's projected unit sales. The sales budget has total sales for May at 25,000 units. So the budgeted production for April is counted as 20,000, which is the sales budget, plus 7,500, which is the desired ending level of April 30th, 30% times 25,000, minus 5,000, which is inventory from the beginning of the month. So we get 22,500. In Exhibit 10.6, you can see the whole quarter's production budget. And you can see how each ending balance for the month goes to the beginning balance of next month. Next, we're moving on to the direct materials budget. We have two required budgets, the usage budget and the purchases budget. Now that we know what our sales are supposed to be and what the production is supposed to be, we can use the direct materials budget. The direct materials usage budget obviously shows how much direct materials were used. And after you know how much materials were used, you obviously can tell or can predict how much you want to purchase. This is the direct materials purchases budget for Carey Company, as you can see with the 3 months, the whole quarter as well. We're done with the direct materials. Now let's look at direct labor budget. Having a good direct labor budget helps companies avoid emergency hiring, labor shortages, and reduced layoffs needs. Also, it helps to plan other activities such as maintenance and training. The book also talks about the overhead budget, which accounts for all other expenses than direct materials and direct labor. Some companies even separate the fixed and variable costs. Now let's work through an example of a direct labor budget. Carey uses 0.5 hours of semi-skilled labor and 0.2 hours of skilled labor per unit at standard wage of $8 per hour and $12 per hour respectively. Using this information, you can look at the direct labor budget from Exhibit 10.9 using each of the skilled and semi-skilled workers. Using the budget for direct material and the budget for direct labor and the budget for overhead, we can now find the budgeted cost of goods manufactured and cost of goods sold. You can see at Exhibit 10.11, it shows the costs of goods manufactured and the cost of goods sold for each month and then for the quarter. From then, we can move on to the budgeted income statement and the budgeted balance sheet. Here is Exhibit 10.11, where you can see the direct materials, direct labor, and total factory overhead. Next in line is the selling and administrative expenses budget, which is obviously all other expenses that don't go into manufacturing. Exhibit 10.12 shows the budget for selling and administrative expenses budget. Next, we will look at the cash budget, which brings together the cash effects of all budgeted activities to ensure that the firm has adequate cash on hand. you will see Exhibit 1013 and 1014 of cash budget and cash receipts budget. As you can see, the cash receipts budget shows the sales data and how the total cash receipts. And if you look at it, it's only the partial one. So if you turn to page 382, you'll find the correct one, the full one. And this is a partial cash budget, which you can find on page 383. The last two budgets we're going to make are the income statement and the balance sheet. As you can see, follow. This is the budgeted income statement on page 384, and that's partial again. And this is the budgeted balance sheet on page 385. The next section is an overview of master budgeting, which entails combining all the individual budgets. It is only valid when the individual budgets are accurate and useful. Because of that, companies use programs to analyze the data and perform a what-if analysis and a sensitivity analysis. A what-if analysis shows how a change in one aspect will affect the other aspect, or what will happen if we changed one variable. The sensitivity analysis, on the other hand, examines the extent of that impact on one change. And lastly, many companies use the integrated budgeting and planning software because those programs integrate the budget with the strategic plan, which helps companies plan better. Next, we're going to talk about budgeting for service companies. Since service companies don't deal with manufacturing or merchandising, they have other worries and planning to do. The main focus is personnel. To provide the service, the company needs employees with the appropriate skills. Another difference is that service companies use revenues instead of sales. Similar to the other companies, service companies will find a revenue budget, and then from then on, they will go to their employees' budget or workers' budget. On page 389 and 390, you can see an example of a service company budgets. There are several alternatives to budgeting approaches. The zero-based budgeting is a budgeting process that requires managers to prepare budgets from a zero base. It only includes activities or functions that will go and be justified in the budget. This is a really time-consuming and difficult process, so some companies use it on a 5-year basis or a 10-year basis. Another alternative for a budgeting approach is activity-based budgeting, or ABB, which is a budgeting process based on activity-based costing. It divides the costs into groups and activity and cost pools. The next approach is time-driven activity-based budgeting, which is a budgeting process based on the use of time-driven activity-based costing, which is an extension of activity-based costing using time. The last approach is the Kaizen continuous improvement budgeting approach, which incorporates continuous improvement exceptions into the budgets. Whenever something is improved, it's added to the budget to save money to reduce the costs. To summarize, there are different types of budgets, but they all interrelate to the master budget. Each budget builds and relies upon the previous budget. The master budget is as valid and accurate as each of the individual budgets. And just like every plan, you must remember the disadvantages and problems that can occur with the budget, which are also exampled in the book. That's it for Chapter 10. Please read over the chapter in the book and do all the homework. Thanks.